everyone. Good morning, good afternoon from wherever you are. Welcome to Apria's Asia Pacific Investment Spotlight. My name is Kim Ong. I'm the Regional Director for Southeast Asia at SGR, a premium data benchmarking, analytics, and marketplace insights provider for the global hospitality industry. SGR is a division of CoStar Group, a leading provider of online real estate marketplaces, information, and analytics in the commercial and residential property markets. Thank you very much for joining us in today's webinar. We will be delving into the dynamic landscape of investment opportunities across various asset classes and sectors. Our speakers, who are thought leaders and industry experts, will be sharing their valuable insights on market trends, growth areas, and strategies for maximizing returns. During the webinar, you may ask questions to the panel by typing in the chat box. To kick off, we have Sigrid Zalsita, CEO of Apria, to start with the welcome remarks. Over to you, Sigrid.
Thank you so much, Kim. A good day to all of you and welcome to Apria's latest Asia Pacific Investment Spotlight webinar. My name is Sigrid and I'm joining you here in Singapore. Today, we are pleased to gather industry leaders across Asia Pacific to discuss some of the latest investment opportunities across various asset classes and sectors. The global economic outlook has improved in recent months as headline inflation has peaked and monetary tightening is about over. For Asia Pacific, the economy is growing at a reasonable pace, even though China's economic recovery has been slow to materialize this year. 2024 is expected to be a stronger year than 2023, with global trade accelerating on the back of recoveries in developed economies and the continued improvement in China. So the webinar today is aimed at unlocking some of the big trends, ideas, and opportunities arising from traditional and alternative asset classes that we all hope you find insightful and useful as you plan for the coming year. And with that, we would like to thank Yardi, our silver sponsor, for making this webinar possible. Before I close, I would like to invite all of you to our flagship conference on October 31st to November 2nd. We will all convene once again here in Singapore for the Asia Pacific Real Assets Leaders Congress. Our theme is Rebounding Asia, as we expect improving prospects for the upcoming year. Please mark your calendars and feel free to ask anyone on the Apria team if you need more information. And with that, I'd like to hand this back to Kim, our host for today. Over to you, Kim.
Thank you, Sigrid. Right, let's kick off real soon. So today's keynote presentation topic is Asia Pacific Macroeconomic Outlook. So what are the factors affecting businesses and investors operating in the Asia Pacific region? Where are the emerging opportunities, potential risks, and strategic considerations needed to navigate the evolving macroeconomic environment? Well, sharing a comprehensive overview of the current and projected economic landscape in the Asia-Pacific region is our keynote speaker, Anshu Jain, Head of Asia-Pacific Tenant Representation and Managing Director, India and Southeast Asia from Cushman & Wakefield.
Muted.
Oh, hi, sorry, I was on mute. Can you? Okay, good. So the joke here is, I suppose, 3 years into talking to people on digital, and we still can't, or at least I still can't learn to unmute in time. So apologies for that. I had given a whole spiel of the beginning of my speech, but here we go again. Thank you, Kim. Thank you, Sigrid. Always a pleasure to speak here. It's a large region, Asia Pacific. Lots of good news in the region, or I'd say comparatively less bad news. And I'll sort of, kick off with my PowerPoints. I can't see my PowerPoint yet, though. Okay, I think I'm probably on the wrong section. Oh, yeah, okay. So next slide, please. First slide. Yeah, quick overview of the region. So largest and fastest growing region by GDP. I guess everybody knows that. Population, middle class consumption, urbanization, big e-commerce market. So if you look at top three themes, which are which has emerged in Asia Pacific, it's really the demographic dividend, the urbanization, particularly in emerging markets, which is kind of driving significant growth. And of course, digitalization, which is the post sort of, we were already digitalizing, which got accelerated post-COVID. So those are the kind of three big themes, which is kind of contributing to our growth story, which is then resulting in the less bad news I was talking about as compared to US and Europe. Next slide, please. So a quick snapshot of where we are. From a growth perspective, just look at those numbers. Overall global, we shrunk in 2020, bounced back. 2021 was a fantastic year, but of course on a much lower base. But look at 22, 23. Global growth, but 24 is actually where a little bit of dichotomy exists, where you see a much better growth coming through in Asia. So both 23 and 24, much better growth coming in Asia, with sort of relatively muted growth in other parts of the world, which is kind of dragging the world economy down. Now that projection is actually changing quarter on quarter. So it's actually very difficult to really pin down where this will be. Sometimes there's recession threat, sometimes there's not in the US, and it's definitely something which we are keeping a very keen eye on. The next slide, please. Yeah, I'm really sorry, I'm not able to see the slides that you have there. Yeah, okay, sorry about that. Big story there again on economy, headline inflation easing, though remain elevated. I think everybody's kind of seen this, so I'm not going to labor on this slide. Next slide, please. But this is probably the most interesting slide. I don't know whether we can accurately ever predict that, but most consensus estimates and our own Cushman & Wakefield Global Research forecast that the policy rates are likely to top up around end of quarter 3, quarter 4. And then the policy rates are going to come back down over the next kind of perhaps 6 to 8 quarters to what could be an equilibrium policy rate, which still is likely to be higher than the long-term policy rate, particularly if you're talking about United Kingdom and perhaps US. So this is likely to settle down by end of 25, and that's probably the most consensus estimate we're seeing anyways. Next slide, please. Equally, consumer confidence is improving. So the red line that you see right in the middle is the baseline for consumer confidence over the last sort of 20 years. And what we're seeing right now is the consumer confidence really hit a rock bottom somewhere in the middle of 2022. And it's kind of started to creep up across most big economies around the world and in Asia. So that's obviously good news. Of course, this again changes very rapidly, so we've got to keep a keen eye on this. But this is what really will drive the GDP growth. So it's something to watch out for. China remains a concern. It's a large sort of consumption economy, but the signs are definitely worrying at this stage. Next slide, please. Coming to a little bit of capital, talking a bit about capital flows. Next slide. So the investment volumes are, on an aggregate in APAC, definitely lower than what we've seen in previous slides. So if you see the red line, that's the investment volume that's kind of coming through this year. And you compare that to the year 2022, you see the line is kind of trending down. It's not very significantly down, but I think most of the investment houses are being very cautious. So there are two issues here. One is a geographic issue where people are cautious about whether we want to put money in China at this stage. And the second reason really is around the asset class, right? So there is office has suddenly become a dirty word. So investors are kind of staying away from office. And as investors are staying away from office, the aggregate volume of investment that's flowing into offices and asset class across APAC is lower than what we saw in previous years. And look at the line in 2021, which was just the post-pandemic line, and look at the pickup from January to December in 2021. It was quite significant. It's the green line right on top. It even beats the 2019 private equity flow or investment flow into real estate in APAC. Next slide, please. So investment right now, as it looks like, has slowed to the pre-2016 levels. You see that red line is the average that we've seen in the year 14, 15, 16. And if you project that, the years, the last sort of 5 years are very good as a real estate investment volume. And we are now kind of trending to what was the 2016 level. Of course, with the projected interest rate decline over the year 2024 or 2025, we'll probably see a better investment volume going through. A lot of chatter is there on obviously the cost of borrowing, which is and the nervousness around some sectors, which is obviously leading to lower investment volumes at this stage. Having said that, the return to office, as we all know, is a lot better in Asia, and there's a bit more confidence in Asian office market than there is in European and Asian office market. I think, therefore, the key factor here is how is inflation, how are the interest rates, and where are the interest rates going to stabilize? So once we start seeing a downward trend in interest rate, I think it's much easier then to price a particular product, and we'll probably see investment volumes returning at that point in time. Next slide, please. Now, of course, APAC compares very favorably, especially compared to India. Now, this is a pretty complex slide, so I'll kind of try and talk you through that. So the short orange line right at the bottom, and just look at the line, that is the investment volume this year. Right. So if you look at and the green line, which is right at the top, is the investment volume in the year 2022. So if you compare to the year 2022, and the blue line in the middle is the average for 17-19. So the 2022 saw massive investments in US, APAC, US and EMEA in the as compared to the long-term average, which was the 17-19 average. It was significantly above, and suddenly in 2023, that's kind of dropped very significantly. Of course, of all the factors I was talking about previously. As compared to that, if you look at APAC, the drop between, let's say, the green line, the blue line, which is long-term average investment, and the orange line is not that much, right? So which is why I was saying that the news in APAC is, of course, a lot less bad from an investment perspective than it is in US and Europe. Next slide, please. Similarly, on the industrial and retail, it's actually slightly better news on industrial and retail. So the far left is the APAC office, investment into APAC offices. And you see the red line again significantly below the other lines, which are previous years, and then the average of 17-19. But you look at the center graph, which is investment in industrial and then investment into retail. as pretty much tracking what we did in 2020. And 2020 was a good year from an industrial and retail investment, or relatively decent year, I would say. I shouldn't say good year. Of course, then it picked up very significantly in 2021 and kind of came back down. And 2022 started coming down. 2023 is flat to 2020, but it's still, I'd say, a good outcome. There seems to be still a lot of interest that remains in industrial and the retail as an asset class. Next slide, please. This has been price correction. It's the over a period of time. And if you see, there is EMEA price corrections been the most sort of evident. Within EMEA, I think Europe's corrected. United Kingdom has corrected the most, and we see investment volumes returning in the UK. And while other places, as I've said, investment volumes remain muted. Next slide, please. That's just how office prime rates have been moving. In most places in Europe and US, there has been decompression in office yields, while in Asian markets, office yields have been a lot more sticky. Next slide, please. And that's that's an interesting chart, actually. The spread between the 10-year government bond and prime office cap rates. And if you see in a lot of market, the prime office cap rates and 10-year government bonds are pretty much trending, at a very similar level, which therefore really means we want to invest in, 10-year government bonds versus real estate seems to be same. Risk is not really being a factor in, or perhaps it is. Risk is not being yet factored in the cap rates, despite decompression in cap rates in some cities. Next slide, please. So a quick review of what's happening in the APAC office sector. Next slide. So the office demand's been stable more or less across APAC over the last sort of 18 months at about 16 million square foot per quarter. I mean, there were a few outliers. If you look at quarter 4 2021, the demand was almost 25 million. I'm talking about net demand here. But the good news is in the last sort of 6 quarters, despite all the negative news about office, the demand's been relatively stable. Next slide, please. And it's really driven by India at this stage at an APAC level. So it's sort of broken down into 2 big markets, China, India, and other markets. So if you see the net demand in India last year was about 37 million square foot, and this is net absorption. Forecast for this year remains at about 37, so it's likely to be a flat year in India with a marginal growth in the next few years. China has kind of dropped from a pre-pandemic of, let's say, around 22 odd million square foot to about 16, 17 million square foot, and is showing moderate growth in the next kind of 3 years. And the rest of the APACs kind of again dropped significantly from where pre-pandemic level, and is trending at about 16 to 17 million square foot. So that's so a lot of office demand in APAC, I would summarize as holding pattern in China, holding pattern in rest of APAC, and in India, it could show a moderate increase, but not that much different at this point in time. Okay, next slide, please. That's kind of resulting in patchy rental growth. I think rental growth is really driven a lot by, previously it was driven by location. Now it's driven by, everything around premium, wellness, the ESG component of the building, and amenities is just attractiveness of the building and whether people are willing to come and work in the building. So I think we're going to have a significant 2-speed market around the world. Good buildings will have 100% occupancy, while older buildings which have not been upgraded and not in the best location will struggle significantly. Next slide, please. From an office occupier condition at the moment, most markets are tenant favorable. But again, I would take this with a pinch of salt. The premium buildings are still in huge demand and at times landlord favorable. But at an aggregate level, it's largely a tenant favorable market. Next slide, please. Quick snapshot, a similar snapshot to industrial sector. That's kind of neutral for most markets towards India. But as you go towards sort of more Eastern Asia, all the markets are extremely landlord favorable, including Australia and New Zealand. The demand for industrial, including logistics and warehouses, is just out of charts, and we just can't build fast enough. Next slide, please. And that's kind of really resulting in good rental growth across the cities. Next slide. Yep, in summary, APAC is rebounding faster and will continue to rebound faster. I think the office market, from an investment perspective, the office market is likely to improve as the interest rates are likely to drop. Industrial and retail after a flurry of activity has kind of gone down a bit. I would say a readjustment period in 2023, and I think it's likely to rebound as we move forward. The headline inflation seems to have peaked, and therefore we probably see a better consumer sentiment as we kind of move forward into the next few years. Generally bullish about APAC property sector, and it's likely that mid-24 onwards, we're likely to see significant activity, probably in all sectors, office, industrial, and retail. Thanks a lot. Pleasure to be here.
Thank you very much, Anshul. That was excellent news indeed from Anshul about the growth in the Asian economies next year. And I understand there's some concerns with what's happening in China, but definitely more exciting times ahead for India, especially for the office assets. So talking about returning to office, and that brings us to the next topic. And the next coming up is actually a panel discussion on the repositioning of the office. So with the pandemic behind us and most of us coming back to work, mostly in the office sector in Asia Pacific continues to present attractive investment opportunities, given that the region is expected to remain the global growth driver through 2030. However, office supply is at risk of becoming obsolete, given that stock in some markets are older or have yet to be green. Exploring the varied opportunities in keeping the office sector relevant are our panelists for the discussion, and they are Quasar Parvez, CEO, Nucleus Office Parks; Neil Anderson, Director and Head of Office, Commercial Property, Hong Kong Land; Amit Grover, Executive Director, DLF Office; and Amar Marani, Chief Investment Officer and Head of Real Estate's 361 Asset. So this panel is moderated by Kranti Mohan, partner, Cyril Amachan Mandalas.
Hi, good afternoon. Am I audible? Hello. Good afternoon, everyone. Am I audible? Okay. Thank you very much for this opportunity. And we have an eminent panel, briefly introduced already by Kim, and we would request each of the panelists to just say a couple of words about themselves. I would not be able to, considering their professional respect and seniority, I would not be able to do justice by saying any introductory words about them. So I would request them to introduce themselves by saying just a couple of words about their roles and their current organizations which they represent. Maybe we can start with you.
Yeah, thank you, Kranti, and thank you, my colleagues on the panel here. Myself, Amit Grover. I'm Executive Director with DLF Office Business. I've been with DLF for 20 years and been a professional real estate professional for over 27 years. I've had the opportunity to drive the growth of the entire office business in India over the last 20 years, from initial about 1.5 million to about 35 million across the regions, and then under development is another 10 million square feet. So we're very proud with the growth of the office business over the years. I look forward to this session and with great look forward to great engagements with my co-panelists. Thank you.
Thanks, Amit. Amar, if you could go next.
Hi, I guess I was on mute. So can you hear me, Kranti?
Yes, we can.
Excellent. So this is Amar Mirani. I head the real assets business in 360 ONE. We are India's leading alternatives fund management business under 360 ONE Asset. I look at infrastructure, commercial real estate, largely speaking, and the various funds that we have raised from the domestic and the offshore markets towards this. Happy to be here and happy to have an engaging discussion with all of you. Thank you.
Thanks. Neil, if you could say a few words about yourself,
sure.
Then followed by Kaiser.
Hi, thank you very much. Thank you. My name is Neil Anderson. I'm the director and commercial head of office space for Hong Kong Land here in Hong Kong. I'm responsible for about 4.8 million square feet of commercial space in Central. But I also manage a portfolio of aging buildings. So I do have some buildings that are relatively new, but I also have some buildings that are relatively old. So I'm here today to talk about the fact that not every old building is unsustainable or obsolete, and I'm very welcome to open that discussion and that debate with what we have here in Hong Kong. I have over 25 years of real estate experience, both in Europe as well as in Asia as well. So I have a reasonable balanced view on what's going on in the world, and hopefully open to some good conversations today. Thank you.
Hi, Kranti. Thanks. Happy to be here, Kranti. My name is Kaiser Pervez, and I run Nucleus Office Parks. Nucleus Office Parks is the operating platform for the privately held office business for Blackstone in India. Our portfolio is roughly about 25 million square feet, fundamentally largely operating asset and small development asset with reputed partners in the south of India. But essentially operating assets and commercial offices building is what we represent, and what I represent in this forum.
Thank you, Kaiser. With that, we can perhaps kickstart the discussion. I think if we are going to talk about repositioning office space, the first question that comes perhaps to anyone's mind, what are the lessons learned from COVID? Has there been any change post-COVID, which is probably perhaps one could argue one key factor which will affect the repositioning and growth of the sector in the future. So maybe considering that there has been keen interest in this sector in India, I would perhaps like Kaiser for you to start first, and then maybe Amit to share his thoughts before I go to Neil and give us a more global perspective, especially from the APAC region, considering Hong Kong is much more developed and has had a more sustainable sector or a long-standing office space sector compared to India. So Kaiser, if you would like to share.
No, thanks, Kranti. On the office side, in real estate, there's a general belief for decades that if you build it, they'll come. But I think what really pandemic did was that the whole perception of the fact that you're just building up the office was not enough. I think the adage has fundamentally changed. from you don't have to just build it for people to come. You will have to operate it brilliantly and please your tenants, and then they will stay. And I think that's essentially is the key learning for people like us in the business of how to sort of navigate through the turbulent times. The sector itself has been, as Anshul mentioned, has one of the most prolific, asset classes, with calling for one of the largest FDIs right from the start of it. But the last 2 years has saw various theories kind of really brushing through the sector. So we heard words and phrases like densification, green offices, work from home, hybrid, and so many others. And I think, a few of them got really pronounced over the last 2 years. But essentially, office has always been sort of an echo bubble where you have seen smaller dips but big rebounds. The sort of pandemic period did see a significant dip, but as we speak, there is a fair bit of rebound which is happening on the office sector. We've been talking about amenities, we've been talking about user of office and so on. But if I have to look at it from my standpoint, a lot of experimentation in the office sector has been from pre-pandemic stage. Imagine a time in 2017 and 2018, a big part of the office and the amenitization of office had actually started then. In 2017 and 2018, an office lobby pretty much resembled like a hotel lobby. So, it's not really the punctuation or the pronouncement of amenities and the user of office now, but it started much before the pandemic. But what the pandemic changed and what the whole situation has changed is how landlords are looking at relationship and how landlords are engaging with the tenants in terms of managing the relationship with the occupiers. If the landlords continue to look at just a provider of space, floors and desks, I don't think so occupiers are in need of a 10-year contract now. They are looking at more flexible, customer-oriented products, and I think that's essentially what the whole adaptive change of the occupiers are, from seeking just floors and desks, but solutions. And landlords needs to adapt to that. So that's been my learning over the last couple of years of how the preferences and tastes of occupiers have changed in the last couple of years.
No, thanks. That's quite useful insight. And Amit, anything more you would like to add, or a different perspective, perhaps?
Sure. Likewise, I think the way we look at it is what pandemic has done is to reestablish the purpose of the physical space. And every time any sector is challenged, it helps for the players to dig deeper into what's the core driver of their offering. So according to me, the office post-pandemic has raised the bar in the ability to connect, collaborate, and belong. In pandemic, people did experience that the alternatives are through these virtual modes, the way we are doing today. But at the same time, when we meet in person in the physical spaces, there's the equity and relationship which we build, has been proven of substantial more value than the ability to connect through virtual modes. And what offices has done has further raised the bar that how do you create more value in terms of experience, in terms of workplace engagement, in terms of creating the bonding, and really enhancing the experience when an employee comes to work. And also acknowledging that work has to be no more a boring place. It has to be high on energy, creating a lot of buzz. And that the developers start delivering to what I call it as a flight for quality, which is raising the bar further in terms of specifications of the building, more moving from A to A plus, enhancing the amenities to further higher standards, enhancing and responding to the needs of the corporates in terms of ESG requirements. And I think that's something which is very core to our company, which we focused on delivering a lot there. And also embracing technology. Post-pandemic, a lot of new prop tech and the technology has emerged in the building operations, access control, access management, and also employee workplace experience. So I think the whole service element has further moved up to a workplace which is delivering an higher level of experience and focus at the end user, which is the employee. And that's the big change where every employee who comes into the complex is treated like a customer. The way, if there is a guest in a hotel, and there is a mindset change in delivering that experience. And I think it's just not stopping there, because consistently, everyone is moving up in that journey, to create more value when an employee travels, let's say half an hour, 45 minutes, or at time 1 hour to come to work. How do you create value that if someone has traveled even 1 hour one way, or maybe 2 hours there, so say, okay, yeah, I traveled 2 hours a day. And is there a value creation? And I think that's where the focus of the developers are coming in, and industry is moving up the value chain in that area. Thank you.
So, Aman, that sorry, Neil, that was India. Is there anything differently, especially Hong Kong, and I would understand that Singapore would largely follow a same pattern, but your thoughts on that?
Sure. I think let's just touch on what we've just heard, because clearly Amit and Quasar are experts in this field already. I mean, what they've said is exactly what we would also say under the circumstances. I think offices can't be boring anymore, I think is a beautiful phrase. And I'd like to thank Amit for that comment, because that's exactly where the future of offices lie. We have definitely pivoted into a digital world. We have now apps that provide services to our tenants and their employees. We're definitely pivoting into a more of a, as well as a B2B model, which we've always had, we're now going B2C. So it's not necessarily the corporate services and making sure that our tenants at a corporate level are happy, but we're also wanting to make sure that their employees are happy coming to our buildings. So there's a definite difference in terms of approach. There's definitely a difference in the type of services that we're providing, whether they're digitally enabled services or physical in nature, depending on the space requirements that you have. Flight to quality off the back of that has been a big driver for us. So we've been very fortunate to have the best, or the top location in Hong Kong, but we've had to fight on the amenity side. We've had to fight on making sure that our ESG credentials are very much top of everyone's agenda. And we've also had to make sure that our property management services is world-class, because that's what people expect now. The experience, the activation of spaces, the events, this kind of creating a kind of what I would call a MOFO, a FOMO kind of positioning, I think is really, really important. That fear of missing out play. And that creates people, when they come to the office, they've got something to talk about other than their jobs. So I think very much similar to Amit and Quasar, we've all the same things and more are what we're seeing in Asia Pacific and in Singapore and in Hong Kong, and we have we're close to the markets, obviously, in Shanghai as well. So what I would say in the three regions that we're very kind of heavily involved with, the back to work thing is 100% on everyone's agenda. There is still a reasonable amount of flexibility in everyone's day, but I would say it's predominantly back to the office for most of our corporate tenants. But their expectation when they've come back post-COVID is different to what it was before. And I think they are expecting more than just space. They're looking for a multitude of other services that they expect their landlord to do on top of the health and the wellness factors that is clearly on top of a lot of people's agenda because of what we've been through in the last 4 years. So I think in a nutshell, that's where I would say Asia Pacific in my world is. But I would also say what Amit and Quasar have mentioned earlier is very, very similar to our views as well.
That's helpful. So, Amar, I'll come back to you. I want your takes on all this inputs from Amit, Kaiser, and Neil, because you represent at some level investors, and you might have a different perspective from them. But since Kaiser has to leave shortly due to other commitments, so I would like to first ask him that apart from this transition, are there any unique challenges coming from either ESG or these newer concepts, which are putting pressures on your profitability, occupancy, etc. What we focused on right now is back to home, but what are the other challenges and that you're seeing in a post-COVID world?
Thanks, Radhi. I think in our experience, what's really happening is that there are two phrases, which is a green premium and a brown discount. Now, when we I think the green premium in terms of ESG sustainability, adherence to the benchmarks, the global standards. Now, while they have become more like a qualifier, each and every good, well-graded occupier will look for such benchmarks and such scorecards, but there isn't really a premium, and it is more really a qualifier. But the brown discount is really a reality. In the event, if you are not up to the mark, quite likely that you will not feature in the option list. And quite likely, if you do feature in the option list, there will be a discount, what you potentially, you can get from the market and so on. So I think so given that fact, increasingly owners and landlords will have to align on the sustainability part of it. And I think for folks such as ourselves, this becomes really a core of the business, because you start thinking about it from the day you are investing in it. You are not doing this as a part of a reactive process because the occupiers are seeking it. You are not doing it because that is something which is what the world is talking about it, but you're doing it just because you are the largest real estate owner in the country. That's something that's a responsibility you have to exude from day zero. So I think that's one challenge one will have to sum out. The second one is obviously the fact that there is a significant gap in terms of the older stock of office and the newer stock of office. The newer stock of office, needless to say, obviously is absolutely making the cut in ESG, sustainability, compliance is right from the design stage. But the older stock of office, and if one sort of juxtapose the older and the newer stock, the vacancy rates and the vacancy percentages in both the stocks will be remarkably different. And I think that's something is important to deal with. As Neil rightly mentioned, old is not obsolete, right? And I think, but in the Indian context, owners and landlords will have to sort of, and as the whole asset class itself is getting more and more institutionalized, there is a consideration in terms of future proofing these buildings, and and that future proofing the building itself, which will be a significant sort of cost, which people will have to underwrite, and not necessarily the payback time for such costs will be near term. It mostly be more in terms of intangibles, in terms of higher leasing velocity, but not necessarily higher leasing valuations. Right? So I think that's really the second challenge. And the third is the overall operating challenges with the elevated inflation, sluggish trade recoveries, the fact that generally the operating environment is not as conducive. There is much lengthier decision-making timelines, either on an investment decision or on a sort of a lease conversation. That itself is a little bit of a challenge, which is surrounding the office market. But again, this is more cyclical in nature. And if you have to look at India, and you have to look at the India story, which is more structural in nature, so I don't consider it to be a challenge. But at least at the moment, that is something which is posing to be a situation to deal with.
Thanks, Kaiser. That's quite insightful. Now, Amar, coming to you, I would like to hear a few words from you, both on the points that were covered previously by the other panelists, and also the points that Kaiser made, before we get some reaction on Kaiser's points from Amit and Neil.
Yeah, so thanks for that. So what I can just see over here is that the landlords and the entire industry, both in India and within Asia, have made considerable efforts to shift the paradigm in the office sector to looking at more an experience for occupants and the employees in the post-COVID era. and raising the benchmark on ESG, on the overall setting up new benchmarks and raising the overall experience. And that is a big reason why this sector is still, in spite of the high vacancies in the more developed markets, but in India, to be specific, there is a strong interest from both institutions as well as family offices to look at investments in the office sector. If you look at the broad headline data, there are 3 office REITs, for example, and we have seen a new listing of a retail REIT very recently. In addition to these 4, there are about 20 to 25 odd infrastructure investment trusts in various developed markets. These would come under the REIT segment, utilities and so on. But all I'm trying to state is that there's a huge amount of interest in stable, consistent, and visible income streams, and that is what investors love about the office and other related segments. We have seen, for example, one of the recent offerings coming from one of the large pension funds through the QIP format, and that also was lapped up pretty well. And all this is happening in an era where there is a fair bit of uncertainty around the overall real estate sector. We have seen residential real estate go through a lot of ups and downs in the last 5-7 years. Things have stabilized there now. Investors, on the whole, have not had a very pleasant experience in the residential real estate sector. But as far as commercial office real estate is concerned, it's far, far better. The returns, even after accounting for the entire COVID situation, even after accounting for interest rates having gone up to significantly higher levels compared to what they were 2 years back, and not looking at coming down in the short term, at least given the recent inflation data that we're seeing, and the entire cloud around the SEZs in India, the special economic zones in India. So in spite of all these 3 factors which are clouding the investment environment in the country, still the stock prices and the valuations are still holding up, and they are above where the IPOs took place about 2 to 3 years back, which just shows the resilience and this underlying fundamental strength of REITs in the country. And even if you look at the private markets, while REITs represents the public markets, but if you look at private markets also, the cap rates and the initial distribution yields still are pretty much maybe 50 to 75 basis points higher than what it was pre-COVID. But again, it's not really gone up too much. It's expanded marginally, and which again reflects a very strong level of interest, again from various segments: offshore, onshore, institutional, and non-institutional, which is the UHNI and the family office segment. Now it represents a situation where we are seeing a more vibrant market. There are newer assets coming on the line. There are older assets, and these are not coming out of distressed positions, as we were discussing a few days back. This is not from distressed positions, but it is coming from a situation where it's either funds reaching the end of fund life, or some of the assets being non-core in nature from some of the larger leading corporates in the country willing to sell off some of their A-grade assets in the commercial office segment. So it's a more of a mature and a stable market that is coming into play, and which is a very good sign for the institutionalization of the office segment in the country. And if you look at the overall numbers of about 750 million square feet of, let's say, A-grade office space, only about 75 million is occupied by the 3 REITs. So that leaves about 90%, which is still to be tapped by various REITs, office funds, and various other vehicles for investors to really play on this entire segment in the real estate sector, in the real estate industry. So all in all, I think I'm pretty bullish at this point in time about, and it's a very high degree of conviction we have about investing in the office segment. And there's enough and more opportunities available at decent entry yields, if I can use that term, as an investment opportunity, even in the top 6 to 7 cities of India. So pretty good times going forward, and hope that we continue to raise the bar on the experience as well as the overall offering in the office segment as we go along in time.
And just to add to what Amar mentioned, the current stock of roughly about 80-90 million square feet, which is in the public vehicles of the office stock, that's scheduled or speculated to get to about 180 million square feet, in the next 2 to 3 years, as a part of the public market vehicles. Now, what that says is roughly about 28% of the whole office stock is going to be in the listed vehicle, and that's roughly about 1/4 of an asset class in the public market segment, which is quite unparalleled, which is absolutely unparalleled to compare to any other asset class, or 1/4 of the whole stock being in listed vehicle itself, and that sort of really increases the attractiveness of the sector itself.
Absolutely, so therefore, in light of what you just said, we seem to be at the beginning of a 5 to 7 year consistent secular movement, and therefore higher investor interest from various segments has just started to show its face, and therefore it's good times ahead for the investing community in this space.
Just one question on that. That doesn't it make it too crowded? 25% already which is unprecedented. So isn't that space already crowded? So is it going to result in lesser demand in the public markets going ahead, or it is an indicator of the faith or the trust markets have in this product and the stability of this segment, which is indicated by this unprecedented public participation?
Shall I take it?
Yes, yes.
Sure. So I think it is reflective of 2-3 factors. One is the level of institutionalization of this entire segment. So earlier, these spaces would be highly fragmented in the hands of dozens of landlords, and now it is coming into more institutional, more formal, high governance structures, and therefore that is definitely a good factor for the industry. Second is that if 25% is only in the listed segment, and this is only A grade office stock, only 25% getting listed, that also over the next 2 to 3 years, currently it's about 10%, it augurs very well from a continuing interest point of view from investors, both institutional as well as non-institutional, which means that the investments that have been made and will continue to be made, because there are high governance structures and good quality sponsors who have taken up larger positions, the expectation of the entire investor community is that this kind of run is here to stay, and it's only going to pick up momentum. And I would contrast this with what happened, let's say, in the public space 10 years back or 15 years back in the real estate segment, in the development play, where we had various sponsors and not so good quality development companies that came into play, and that resulted in the entire sector coming down for 5 to 7 years at least, and there was hardly any activity. This is completely different. High quality sponsors, very good assets, and good governance structures in the REIT framework coming into play at the same time, having seen the worst time possibly of COVID, high interest rates, and special economic zones having seen behind us, and with the high quality assets and sponsors raising the bar even further. I mean, it's the best that one could ask for from a long-term sustainable capital market inflows as well as interest levels for the next many years to come.
Thanks, Amar. That was helpful. So, Neil, I would like to ask you first. How do you see rest of APAC behaving differently compared to what we largely heard about what is happening in India? Your thoughts on the rest of APAC, especially Hong Kong? How is the investor interest there? It's already a very successful REIT market, so maybe that's not a new thing there. But how are generally investors viewing the office space?
Okay, so I think probably first and foremost, and I picked this up on one of Anshal's graphs earlier, where it had cap rates in Hong Kong at 2% when interest rates are at 5%. So it's quite an unusual market to be in from that perspective. But what it also shows you is that actually to enter our market, you have to have pretty low gearing, because at the end of the day, the finance costs outweigh the return. Doesn't make an awful lot of sense. So, but on the back of that, Hong Kong is I would say in a pretty cautious market at the moment in time. There's definitely not a lot. It's low activity, but what I would say it's opportunistic. So you have a situation where, you know, there's no distress, but what I would say is that there are opportunities for people to enter a market which usually has a very high level of barrier to enter in the first place. So it is a long-term play for sure, and it is something that you just have to be very cautious of on your position of entry, and obviously look into the details of the market. For the rest of Asia Pac, I can't really comment too much because not really from the investment angle. I'm not an investment agent, so
right.
But what I would say in terms of market sentiment towards offices, I would say because of the return to work has been so prominent, which is very, very different, structurally different to what you're seeing in the West. I still see office as a key asset sector that investors are looking at quite carefully. So I think that's every market in Asia is also very, very different. Whilst there is, you know, because the interest rate environment is very different in every Asia city as well, and the supply demand side is also quite different. So I think you have to look at each location in its entirety, and then look at each investment opportunity in its entirety as well. So it's not there's no sweeping comment that covers it all, other than tenants are getting back to work. They like coming to work, and that is a structural change which isn't affecting Asia, which is affecting other parts of the world. So I would probably leave it at that for the time being.
Right. Thanks. Amit, any thoughts that you have?
Yeah, I think, you know, my colleagues have said, but I think, you know, I'm pretty bullish on the office segment on account of various factors. That one is, fortunately, the macroeconomic position for India is going good, consistently growing up the ladder in terms of our GDP growth. Our demand is good, you know, consistently, even post-pandemic. If you see last 1 year, more so in the last a year or so, we've seen an incremental demand from global captives, you know, in a big way. I mean, there are still, as per the NASSCOM recent report, still another 400 global captives companies are looking at entering into India, and the ones which are already present are growing. So that gives us a very strong confidence on the office segment. At the same time, the domestic companies have also been growing. I mean, we're fortunate that out of the global pool of the unicorns, I think, which is over 1,200 unicorns globally, 110 are in India, so which also reflects a strong domestic economy growing, and therefore the overall employment base growing, which is the fundamental driver for office space in requirement. So consistently, we see, as long as the companies you know, keep on delivering on the top A+ assets and a grade A experience, we see the among all sectors, the commercial real estate and the office segment to be a very strong demand driver and a very strong asset base in terms of delivering consistent returns and stable returns. So that's kind of a future view on this. Having said that, you asked one question on challenges. I think the couple of challenges which everyone is kind of very well is driving return to work for because wherever the return to work are more, your future demand will come. So as developers, how do you focus partner on you know, return to work becomes important. How do you literally become like an extension of HR of the organization, or a tenant of the organization becomes very important. How do you also drive infrastructure, whether in the city or in and around the projects, will be very important. As to reduce the commuting time of the employees coming to work, and therefore enabling and encouraging more and more employees to return to work or / enjoy coming to office. So I think the development will further widen to just providing a physical space per se, and have to take a end-to-end ownership of the experience. The moment in some way the employee leaves home, how much is the commuting time, how is the enjoyment at office, and that will drive more footfall in the offices and consistently more growth for the office segment. So it's broadened everyone's vision, and otherwise, if someone keeps delivering that A+ experience in an end-to-end format, I think is the best office, best asset class to be in, and we are very bullish about it.
Thanks, Amit. One other important question: what are the sectors, the industry or services sectors, that are driving the growth or are likely to drive the growth in the office space segment? Because again, with the IT sector, a lot of progression style of or change in style of working, both, and I would like that perspective from all of you, because Amar's perspective would be very different from Amit. Your and Kaiser's and Hong Kong would work differently. And like Amit, you mentioned that with a significant number of unicorns in India, that is likely going to have an impact. So that's one side. But are there any other emerging sectors that would fuel this office space growth?
Yeah, sure. So I can add on. So what post-pandemic, what we've seen in the last 2 years is more high-end work coming to India. The number of IPs which are getting registered in India have increased. There is like deep tech, AI work coming to India, more so somewhat in South India, where the talent pool for the AI is even more. We're also seeing some biotech companies coming into India, more of animation companies coming to India. So I think the whole is no more the operations level of BPO. I think we're getting into more high tech development work and AI work coming to India. I've seen product design companies further enhancing their patents registration in India, and therefore are doing a super high tech work there. So across segments, we've seen the global captives growing. Please appreciate there are still, when the global captives look at what percentage of their global workforce is as part of the GCCs in India, they believe that that percentage can further increase. And most global companies will have, let's say, 3,000 to 4,000 employees. Even if they increase 10 to 15% each across the board, there is huge demand opportunity for India. I mean, currently we are at, as an industry, we are at almost 700 billion square feet, but I think we won't be surprised that by 2030, this figure can go up to 1.2 billion with the consistent growth of at least 10 to 15% per year. Yeah, that's my view.
Yeah. So before Amar and Neil, you share your thoughts, I just want to challenge you on one point. You mentioned that more high-end work is coming. Would that not mean lesser number of employees and therefore lesser demand? Hello.
I can add on, right? So the high-end work would go to A+ buildings, right? And it is more work coming to India as a headcount. So in the last 3 years, most tech companies have increased their headcount by about 1.3 to 1.5x. So some of them were working from home. The moment the return to work percentage increases, all the hiring which is last 3 years have been done will drive the footfall back there. But yes, you're right. The high-end work would be delivered through A+ buildings and A+ experience. So definitely, right now as we speak, there is shortage of A+ buildings in supply, while there could be vacancies in grade B and grade C buildings. So that's the trend which we are seeing right now. So definitely, for still less stock available for our A+ buildings and A+ experience,
which is an opportunity for growth, by all means. Yeah. Amar, again, your thoughts are: do you sort of, as an investor, agree with Amit's marketing pitch, so to speak? Do you or do you have some different and contrarian views before we go to Neil and try to understand how Hong Kong is going to be different or has been different from the India story?
So I completely agree to one point which Amit said, which is that high quality GCCs and high quality occupiers want grade A plus office spaces. I mean, I've seen, for example, in Gurgaon, which is Amit's home market, uh, specific occupiers, specific tenants moving out from 70, 75, which is like 80, 90 cents per square foot, to 1.2, $1.3 per square foot in the same micro market, from a, let's say, grade A minus building to a grade A plus building within a span of 3 to 6 months. I've seen that, and that I'm sure that is reflective of what's happening across the country in the top 5-6 cities. However, that doesn't mean that grade A minus and grade A and grade B plus don't have a market. That's a different market altogether. That's a price sensitive category. But what I would state on that is that with more of the high quality work coming to India from GCCs and others, and this trend is only increasing as we go along, this also raises the headroom for us to increase on the rentals. We have been traditionally a $1 market across cities, roughly speaking. And if you compare with, I was reading a recent report of JLL, if you compare with other markets like Jakarta or Shanghai or Seoul, we are significantly low. With high quality occupiers and greater A plus buildings, there is certainly a runway and a headroom available for us to look at, and visible growth of beyond $1 to $1.2, $1.3 a square foot in these A plus office spaces. In addition to them being reasonably well occupied in the short term, there's also a scope for this happening. We are not factoring this at this point in time. This remains an upside scenario from an investor point of view. But if this actually results in, I mean, if it results in actually happening in the next 1 year to 1.5 years, we will see even stronger interest from institutional investors coming in. This is currently not factored in, as I said, quality is here to stay. This has been seen very well in the last 3-4 years in the residential segment, and the polarization between higher quality and lower quality has been well established there. It's also happening very visibly in the commercial segment, in the A to A plus migration. Very, very true on that.
Thanks, Amar. Neil, your thoughts on
Sure.
Hong
So
Kong
I'm going to keep,
specifically, and
yep,
if you have on rest of APAC as well.
Sure, I'm going to keep it quite brief. I know we're running a little bit close to time. So I think first and foremost, Hong Kong and largely Singapore and Shanghai are international finance centers. So fundamentally, my tenant base and the tenant base here and demand for office space is largely driven by the finance sector, whether that's legal, banking, accounting, consulting kind of services. So it is a key pillar of the trades that we have, which drives the markets in all three locations to a larger extent. But Hong Kong in particular is very much a finance related, stock exchange driven, IPO driven market from an office demand point of view. As to what happens next and what are key drivers in the next 5 to 10 years, I see digital currency being quite a big player. We're not a tech center, but Shenzhen and Guangzhou across the border are tech hubs. So I see digital currency, digital technology being a big driver. Whether you put crypto in that field, I'm not so sure yet, but I think it is being regulated here in Hong Kong to a minor extent, and we have regulated platforms here. The big takeaway for me, I was in Shanghai about 6 weeks ago, and I paid for everything from the taxi driver to the hotel to the dinner with my phone. And that kind of blew me away that, look, you know, we're moving into a world where it's a mobile wallet where everything's on your phone and everything is serviced through your phone, even the taxi driver, which I think was quite surprised me actually getting from the airport. So I think we're moving into that technology world, and the technology and the companies and the banking side of all of that will definitely bring, I think, a new sector to the finance world in terms of what I live and breathe on a day-to-day basis. So that's my quick takeaway. I know we're short on time, but I think digital payment systems, digital platforms are definitely on the agenda for the finance world, and I see that being a shift in the next couple of years for sure.
Thanks, me. We have only 2 minutes. We had 2 questions. I think we've touched on a lot of topics, left a lot of questions unanswered. I could go on asking another 4 or 5 questions, but I think we have only exactly 3 minutes, and we had 2 questions. The first one, probably we don't need to spend too much time. Where India focused the 28% GST on gaming is a impact. Maybe in 30 seconds, if Amar and Amit, you can respond. And the larger question, and again, that probably is addressed to all 3 of you, is there a movement from single occupier taking up large spaces to taking multiple location, smaller office spaces? That might be more relevant in India considering infrastructure constraints. But your quick thoughts, and we really have just 2 minutes for these 2 questions. Any one of you can go ahead. These are the questions that have come from the audience. So please.
So I can take the second one if you want. I want to jump in on the first. So yeah, on the quick one, on the multiple locations, yes, certain tech companies are giving the flexibility to the employees to operate from tier 2. That flexibility to work from anywhere is coming in. But we see that as a trend which will start fading out. India has always been a career-hungry country where the youngsters likes to come to the main cities and drive their career upwards. I think this whole thing about multiple locations thing will gradually fade. But at the same time, the main cities, the main bigger cities, the suburbs will flourish. People will have bigger homes and therefore will operate from suburban as well as city center locations. That's my view.
Neil, any thoughts? And Neil, is it therefore are we moving towards, with what Amit said, towards an American model?
I'm not so sure. I mean, we coin it. It's the hub and spoke strategy, right? If you have your kind of core office and then you have spoke or satellite offices that surround it, I think we're moving into a world of definitely where collaboration is quite important for most of the businesses that I see. And I think it's very, very difficult to collaborate on a hub and spoke model because you're not too sure where anybody is at any given time. So I think it is very trade specific. We see in banking definitely a back office and a front office kind of play. But I think for the most, it's quite rare, subject to the scale of the companies. I think there is a certain point where a company can get to such a big scale that they do need to have satellite offices and they do need to have, a quite an important head office that supports that. But I think in Hong Kong, because of the scale of a lot of the tenants, actually most of them go for a prime site or a site that fits everybody, and then the business, I think, is more efficiently run on the fact that everyone's under one roof. I've seen one other thing that kind of came out, which I'm not too sure has worked too well, where one of the banks actually did a partnership agreement with a co-working company where their staff could go in and drop-in centers in various places, but they kept their head office where it was. I think that the jury's still out to as whether or not that actually worked very well or not, but we'll probably know more in the next 6 to 8 months. I think again, it's a trial kind of play to see whether that worked or not. But I think what we see here is core office, core location, flight to quality play is what their employees want, and it's where they want to work. And I think that's the key driver to this. So yeah, that's my views on the position.
Yeah, I think I would echo to some extent what Neil just said. It really depends on what the processes and what the end user industry is all about. In technology, there is a fair bit of possibilities of a more of a hub and spoke model, but in front office banking or in GCCs, many of their segments, it may not be very easily doable to on a scalable manner. And again, given that infrastructure development has and is taking place in many parts of these top 6-7 cities, which makes the 1 to 1.5 hour commute more easier for all the employees to come in. Less of, I mean, more of centralized is perhaps we will get into in the next 1 to 1.5 years.
Thank you. Thanks everyone. And I think we've not just run out of time, we've exceeded it. But thank you so much for these wonderful insights. And I think it's improved all our understanding on this core sector for economic growth. Thank you so much.
Thank you, Kranti.
Thank you, Kranti. Thank you, everyone.
Thank you, everybody.
Thank you.
Yes, thank you very much, Kranti and panelists, for such an insightful discussion. I do like the phrase from Amit, officers can't be boring anymore. And also, Neil, your sharing of the fear of missing out FOMO. We have a Singaporean slang for it, and it's called kiasu. Jokes aside, so old is still gold, and Hong Kong still does pose some good investment opportunities. But as we come out of COVID, people's expectations are now higher and more. And so going back to the office is not just a place to go to work to, but it's also about wellness, the surrounding infrastructure and amenities, of course, more importantly, ESG compliance. So it's very important to ensure that you're up to mark in those areas, and particularly in sustainability.